Welcome. I am Ernie Goss, McAllister Chair and Professor of Economics here at Creighton University in beautiful downtown Omaha, Nebraska. Here I am to report on business conditions for the Mid-America region that's stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. The indices range from 0 to 150 is growth neutral, and we're talking here. I am reporting on business conditions in the 9-state region for the month of July. Now, how was it? Not good. After 5 straight months of the index being above growth neutral or 50, the index moved slightly below growth neutral. Now, that's still not a concern. Now, I'm not saying you should start putting groceries in the cellar or the basement. No, it's not like that. The overall index declined to 47.6. Now, that's not good, of course, from June's 50.1. So things are moving in the wrong direction, and here you'll see that index. I'm bringing up the chart here, and you'll see in beautiful Creighton blue there the Mid-America, which as you see is pointing down and below growth neutral 50. And there you see in red, that's moving, it's moving in the opposite direction positively, and so the gap is growing there. Now the number for the U.S. will come out later on this morning. We're here on August the 1st. That number is still, the gap is growing, and we're at least what we're talking about here is growth. The gap between the U.S. and the Mid-America region is apt to expand, meaning higher growth for the U.S., slower growth for the Mid-American region. The job index, July was 46.9. That's down from June's 46.1. Still, that's weak. And we ask about what over the past year, what are the big factors that are driving the sales of your company? 34.3, that's over 1/3, said the global economic conditions. Surprising here, we're in the midsection of the country, but we are hammered by global tensions, which increase the value of the dollar, pushing down ag prices and, of course, energy prices. 20.9% said the farm economy. So that, again, we don't survey. These are not farmers we're surveying. We're surveying the businesses that are linked to the farmer, and that's big as well. So those are factors that were really pulling down the overall index, and that's why we're seeing and why I'm expecting growth, still growth for the region, but the gap between the U.S. and the Mid-America region is going to grow as U.S., a little better growth there. The prices paid index, that's wholesale prices, 60.8 for the month of July. That's down from June's 66.6. We ask about how much do you expect prices to grow for the rest of the year. 1.6%. Now that's a bit stronger than you'd like to see, at least from the Federal Reserve standpoint, and I'll talk about that momentarily. Now, what do you watch for other than, of course, our economic reports? The July jobs report comes out this Friday. That's August the 5th. Keep an eye on that number. Look at it with a big magnifying glass. If that number is below 100,000 jobs added for the month of July, that's going to put the Fed on the side of not reducing interest rates so you can continue to borrow cheaply. If it's above 200,000, I think we could see a rate hike as early as September, and that's my concern. I think the Fed needs to begin raising rates. I think we should see a rate hike in September. I'm expecting it. I'm putting about a 30 to 40% probability. Obviously, higher probability of not doing it, but still, I think they should. Keep an eye on the CPI for July. That comes out August the 16th, Consumer Price Index. Watch the core. The core is a CPI which excludes food and energy. For 8 straight months, it's been above 2%. So watch it. It's moving toward that magic number of 3%, and that's my concern level when it gets to that. And again, pushing the Fed to raise rates. And I think they should be raising rates. The yield on the 10-year Treasury, I talk about that almost every month, but why? Because it's a real measure of risk and inflation. When it comes down, that's a higher risk as investors flock to our bonds, lending to us at lower and lower rates. And as you know, your mortgage rates have come down since Brexit on June the 23rd. When at least the vote on Brexit. So those are three things to watch. Now, risk. What are the risks? Stronger U.S. dollar, it is a huge risk, and it goes, I won't say not ignored, but not as much attention is paid to it as there should be. That brings down agricultural commodity prices, energy commodity prices. And by the way, I should have brought up, keep an eye on gasoline, or oil prices. Oil prices could move below 40. That's not a good number, at least for the economy. I want to see it between 40 and 60. I'd like to see it hovering around 50. That's where I'd like to see it for the economy's sake. U.S. inflation rate, keep an eye on that as it moves toward 3%. That's a core again. Higher short-term interest rates. When you see short-term interest rates coming up, that's in anticipation of a Federal Reserve rate hike again in September. So that's something else to watch, and watch that, of course, the Federal Reserve, what they do in September. Well, that's it, folks. It was an okay report. Not as good as we've seen this time last year. Things are moving in the wrong direction in terms of growth. What it's showing is slower growth. Inflationary pressures still a little bit higher than we'd like to see. The economy is slowing down relative to the U.S. U.S. is a bit stronger. But so we'll have to wait here. Here again, I'll be here on the first business day of September. That's September the 1st. Until we meet then, may your economic cup runneth over.